Canadian telecom stocks have traditionally been viewed as a relatively steady part of the market. More recently, some of the major names in the space have been under pressure. Joining us now to discuss whether better days may be ahead is Vince Valentini, Managing Director for Equity Research with TD Cowen. And for full disclosure on the companies covered by TD Cowen, a division of TD Securities, please see the link to the website at the end of this video. Vince, great to have you back on the program as always.
Great to be here, Greg. I'm glad I could do it today because there has been a tremendous amount of pain for these stocks recently and a lot of uncertainty. So hopefully I can't give anybody any silver linings or guarantees that the pain is going to end immediately, but at least I can hopefully clarify some of the issues. And
some news recently too. I mean, we heard from BCE. I think there's a lot of expectations around some of these names or what they may or may not do going forward to address this weakness. So let's start with the weakness that we have seen. Why are we not out of this sort of cycle?
Yeah, so let me break it down into three buckets. There's industry concerns, which is basically the same thing we've had for 18 months, is people worried about pricing in the industry, especially in wireless, a little bit of concern about population growth slowing down, and that impacts all the players. So TELUS, Quebecor, Cogeco, those stocks haven't done great either. But then you have these company-specific concerns just for BC and Rogers, and they have both companies put themselves in a pretty bad situation with a lot of uncertainty around their balance sheets and around certain funding necessities coming up. And investors just clearly don't like that. They are voting with their feet that they're selling these stocks because they don't like the uncertainty. The good news with that is once you get clarity on the issues, hopefully those stocks can bounce back, and we can talk about both of them individually in a minute. Just the third bucket is more macro stuff, which impacts, you mentioned tariffs a second ago, impacts everybody. If you're a Canadian, people are worried that the Canadian economy could be at risk. This sector is not, it's a very recession-resistant sector, but it's not totally immune to a recession. So people are worried just about the overall economic picture. Obviously, bond yields are a bit fluctuating. Canada's quite low, but people are keying off the U.S. bond yields that have moved up since the U.S. election. So that those kind of macro things add a little bit more misery on top of the pie here for all these stocks. But the biggest thing, which I think we want to certainly dive into a bit deeper, maybe in your next question, is BC and Rogers, exactly what are the issues and how can they get resolved?
Let's dive into that as well. I'm thinking we've heard from some of them in recent days in terms of, the investment community wanting to know. So these are the issues facing you. What do you plan to do about it? Do we have any more clarity that gives us a bit of hope this year?
We don't have any clarity, and that's the problem. Rogers reported 10 days ago, BC reported last Thursday, and neither company came out categorically dealing with the issues that investors have told them for a few months. This is what we're worried about. They're kind of separate, so you have to deal with them separately. Let's do BCE first because it was more recent, and I published on it on Friday. People just flat out now want to see the dividend cut. Nobody thinks the dividend is sustainable. They think it is creating more problem than it solves. They also have an expensive dividend reinvestment program that they put in place a few months ago, and that's starting to kick in. So they'll be having to issue a lot of shares, which is dilutive as if they keep paying a close to $4 dividend. And as long as you keep paying that dividend, your payout ratio is over 100%, so you're not generating any excess free cash flow, you can't pay down your debt, and most people think BC has too much debt on their balance sheet. And that's even before you get to the transactions that are supposed to close later this year. Yes, they're selling MLSE for $4.7 billion, but they're paying $7 billion for their U.S. fiber business called Ziply, so there's still more of a net cash outflow to add to their debt level in the future. So people want them to come out and say, get rid of the drip, cut the dividend, reset it to a more sustainable level, and then the stock's already reset lower. The dividend yield is over 12%. Clearly people are expecting a cut. So just do it, rip the Band-Aid off, and then from that point we can assess, is the balance sheet strong enough to have confidence to go back into this name. They gave a little bit of a hint on their call last Thursday that maybe they're warming up to that idea. Some of their language around the dividend was not as confident as it had been in the past. It was not listed as one of their key 4 priorities going forward. So I think some people, including myself, have taken that as a signal that we're getting close to some good news of them resetting the capital allocation priorities. We actually put into our numbers officially now expecting a 50% dividend cut as of their first quarter results in May, and I think it's good news for the stock. Can't guarantee the stock would go up day one. You never know what kind of impact those kind of events are going to
How the street
have.
will
And-
take it, right?
Yeah, but I think in the long run, the institutional investors in Canada would cheer that move, and it would bring back some more support to the name. So that's BCE, mostly to do with balance sheet and capital allocation. Rogers also has a balance sheet problem. They've had a balance sheet problem ever since they acquired Shaw. They used a lot of debt to make that acquisition. They had made promises about getting that debt leverage down. They haven't been able to live up to those promises, in part because the industry got a bit more competitive. They don't have quite as much cash flow as they thought they'd have to pay down debt organically. And some of their inorganic initiatives to sell non-core assets haven't come to light yet. They've been quite delayed at selling real estate and their data centers. So that has led to a situation where people now think they have a big funding gap. They've agreed to pay $4.7 billion to BCE for that Maple Leaf Sports and Entertainment stake. People say, how are you going to get that money? Your debt leverage is already too high. They announced a funding structure late last year, $7 billion in partnership with a private equity firm, which most people think is Blackstone, to outsource some of their infrastructure. It was a very unique and in some ways strange funding structure that the investment community is still trying to understand. And they refused to give any details about how the mechanics of it work. So they've left us all wondering. And again, investors don't like that uncertainty. Now, just last Thursday, they announced that they're doing another issue of hybrids. Rogers has used these in the past. They're now issuing more, seemingly up to $4 billion worth of it, which is basically just pure debt, but it's debt that gets partial equity treatment by the credit rating agencies. So you get 50% equity treatment from Moody's and S&P and 50% debt. So you're willing to pay a bit more in terms of the coupon and the carrying cost to get that treatment. So they announced that, and that just added even more uncertainty to people saying, well, if you're doing that, does that mean your infrastructure funding you announced last year isn't happening? Does it mean you don't have confidence you can monetize the sports teams the way you thought you could? So it's really just, I've never seen such a dark cloud of uncertainty, and unfortunately, management is catering to their own long-term future by saying we don't want to negotiate in public. We haven't finished these deals yet. We've got a lot of people we need to negotiate with. We can't tell you investors all about what we're doing, or else we're going to tip our hand to those people. And I understand what they're doing, but the investors just don't like it. Even though they may understand it, that's great, but I'm still not going to touch the stock until you give us the clarity. So there's a bit of a vacuum here, Greg, unfortunately, where if anybody wants to sell the stock, including short sellers, they're selling it into an environment where there's just not the normal flow of buyers there on the other side. And it's created a bit of a gap here where BC and Rogers have both fallen dramatically in very short order. Touch wood, 6 months from now, the air will have cleared and we will have much more certainty on what the balance sheets look like. We can come back to fundamentals, and the good news is the fundamentals in the industry are actually starting to improve in the last 6 weeks. But nobody's paying attention to that for Rogers and BCE because of all the company-specific uncertainty. Sorry, I rambled on a bit, but I think these are such
There's
huge
a lot going
issues.
on there.
A lot going on, and people are very confused. And my phone is ringing off the hook from not just people on who will be watching this show, but the institutional investors as well, who are very confused about the situation for both of these names. But that's where we are. It's basically both have too much debt. There's too much uncertainty about how they fix it. Management teams have a plan. They're just not telling us all the details of those plans yet. So people are saying, until you've done that, we're going to steer clear and we will buy something else instead. So the stocks are both in the penalty box.